We're going now. So, good morning, everyone. Glad you're able to be with us this morning. Got a fine crew uh, on, and look forward to listening to their presentations and seeing what kind of uh, marketing information that we can possibly use to our benefit. This morning, again, we're going to start off with Dr. Robinson with the cotton marketing update, but just want to thank our sponsors, the Texas Sorghum Producers Board, the Texas Corn Board, and the Cotton Board. And they do great things for our industry, and we're just grateful for their presence and uh, helping our producers and our industry out. So that said, Dr. Robinson, if you want to go ahead and take off and get after it.
All right. I'm waiting for it to let me share. It's not letting me share, Bob.
Okay. Do y'all know which one of these
Oh,
buttons
select
that
window.
help?
Okay, wait a second. Wait a second. Here we go. Yeah, here we go. Allow. Okay, can you see that? I
Yes,
can see
sir.
my screen. Okay,
Yeah,
good.
you're in. There you go. You're still in. Like, there we go.
Let me go back up to the top. Okay, so here's where we are uh, in the cotton price situation. We're in a, if you look at the lower right end of the chart, we've been stuck for many months now in a narrow trading range of prices. And, we've been 66, 67, 68 cents for a while now. Um, with, to be honest, without a whole lot of uh, reason for expecting a major move out of this range for the old crop situation. But let's look at some of the reasons why. We've got supply and demand numbers. The right-hand side of this column represents the August numbers for U.S. cotton. And I'm just going to focus you down here at the very bottom where it says 3.6. That's the forecast of cotton, million bales of carryover or ending stocks, what's left over. And it's a little bit, they've been tightening up the balance sheet, tightening up the supply side, and that's why this ending stocks number has been shrinking. It's a little bit, it's projected to be within 400,000 bales of last year's ending stocks number. So that's basically what I'd call a neutral outcome, which the price implication of that is I kind of expect the same range of prices for the 25 crop that we saw for the 24 crop. And for the 24 crop, prices were basically from the mid 60s to the mid 70s. So this is sort of a fundamental reason to say I expect more of the same. Of course, there's a lot of moving parts in this balance sheet, so I'll focus on a few of them for the balance of this talk. There's also the influence of speculators that are still in the cotton market, selling the market outright. That's what this downward green area, that implies a whole bunch of people have taken a position where they sold the market and they're waiting to buy it back and make a profit on a downtrend. We're almost at the record level that we were at back in the spring. That's this third from the last real big downward green spike. We're holding it at a similar level, just sitting there. They've already sold the market, so it's not getting more bearish. It's just kind of holding. This is one of the things that's holding us in this flat pattern. And when these people, as a silver lining, when these people finally decide to buy back these positions, that represents buying. That may give us a what I would consider to be a temporary lift in prices could happen if these people all decided to get out of this position at the same time. Nothing has scared them out of their positions yet, but we'll have to see. Some kind of bullish news um, might they might act as a catalyst on top of that if it was to happen. Just some quick background. This is still China's still the #1 producer, followed by India, and we used to be third, and now we're fourth behind Brazil. Brazil is our major production and export competitor. Brazil's production, the trend of it is in the red line here, and you can see it's definitely an uptrend, while our other major competitor is Australia, and they're producing at the upper end of their 2 to 5 million bale typical range. So lots of cotton in the world competing with us, and it's competing with our exports. The U.S. in this chart is the red, and you can see Brazil's the orange, and Brazil's exports have gone in 10, 15 years have gone from just a few million bales to competing with us in a big way. They've been expanding their exports because they've been expanding their production. So kind of the major threat to our industry is the expansion and success of Brazil as a producer and as an exporter. I'll skip that. Demand influences. This is a picture of world consumption measured in millions of bales. You can see this big dip in the middle is the drop in world mill use during COVID, and then there's a sharp recovery coming out of COVID, and then the stimulus wore off, and we were worried about inflation and slowing economies and stagflation, and we saw another dip in 2021 and 22 and 23, and then that bottomed, and we seem to be world mill use is trying to get back to the pre-COVID levels. I take this to be a somewhat good sign as long as we keep up trending. But cotton consumption is something that depends a lot on just how the general economy is going and how consumers feel and whether they're up to buying apparel and home furnishings or not, and that's hurt if economic times are bad. And so that's kind of an open question whether this trend at the end will continue. This is a breakdown of just the countries, and a lot of them are the same countries that are the major users of cotton in the world. Again, China's the big dog, and India is important, and Pakistan's important. This is a busy chart, but it shows a number of things. If you look over here on the right, China is the dark blue part of this chart, and back in 23, there's a big increase in cotton imports. China ramped up their imports. What they were doing was filling up their government warehouses. They have a strategic reserve, and they had emptied all the cotton out of that reserve, and here in 23 they're buying a ton of cotton to put back into that reserve. Having done that for the last 2 years, this year included, they're not importing very much at all from anybody. So China is kind of out of the market, which is a bit disruptive. Fortunately, this is some of the limited good news in this talk. Fortunately, the other countries that import cotton seem to be making up the difference. All these other different colors, they've expanded and sort of filled the gap, and so we're exporting to them. That's people like Indonesia and Bangladesh, Vietnam, and Pakistan and India. They've all become very important destinations of U.S. cotton, and so that kind of is our market. So these countries, they buy cotton when they think the times are good and that they can sell the thread and sell the apparel. So we need the world economy to keep humming along and not slip into recession, and then these guys will do their thing and buy our cotton. But that's kind of where we are. Quick word on tariffs. China has tariffs on imports of U.S. cotton. I think they're the only country that does direct tariffs. But China's not doing very much buying, so that's really not much of a lost opportunity because there's not much cotton to apply a tariff to. In other news, we actually have negotiated agreements, or there's talk of us negotiating agreements, trade agreements with Indonesia and Vietnam that specify those countries buying cotton from us. So that's a good thing. And the only other thing I'll say about tariffs is, in a general sense, if tariffs or the threat of tariffs slow economic growth, then, as I've already kind of implied, that's anything that slows economic growth is bad for cotton consumption, because people cut back on apparel during tough times. So that's kind of where we are with the tariffs. So hopefully that picture is stabilizing and the uncertainty is minimal. I've already said that, so I'll just skip on. The weekly export sales of cotton they've been so-so. We've had a number between 100 and 250,000 bales in recent weeks. That would be okay. We need a lot more of that to be evidence that cotton demand is improving. So that kind of just brings us to the normal situation. The normal situation for this time of the year is for low harvest time prices. This is the average of December cotton futures prices converted to a 0-1 index. The 1 is the highest prices of the season, and that typically happens at the end of May and June. And then we have the market digesting information about the size of the crop. That happens in the summer. I think that's already happened. And so we're kind of in the season of seasonal weakness where we have downward pressure. So this is seasonally, I wouldn't really expect too many more surprises in the news that would lift prices much. So I think we're going to continue range bound, and most of the hope for the market is for prices to go higher next year. So that pretty much wraps it up. Fundamentally, there's really no reason for a large rally. Seasonally, there's no reason for a large rally. Hopefully the tariffs and other situations won't put a wet blanket on any possibility. And Bob, with that, I will get out of this. Don't want to do that. Don't say. There we go. I want to stop sharing.
Yeah, you're good.
Okay. Have I stopped sharing?
Yes, sir.
Okay, good.
Yes, sir. Yeah, it's all good. Yeah. Thank you, Dr. Robinson. Again, good information. Sometimes would like to have a little better, but it is what it is. But we do know good information to know. This time, I think we introduced Kara Matheny last time we met, but just wanted to do it again. She's co-hosting this little program, and she's the Ag Natural Resource Agent in Victoria County, has been there a few months now, and we're glad to have her on board. She's traveling today, so but I think she was able to jump in via phone. So glad to have Kara with us this morning. If she has anything to say a little later, well, she can sure enough jump in at any time. So with that, we'll go ahead and move to Dr. Anderson, David Anderson, our livestock specialist, marketing specialist in College Station. And
great. Let's see here. Oh, Lord. I was sitting here thinking about how I make this thing share. Is it sharing at all?
yes, it's sharing one of your screens, I believe.
Well, let's see.
There you go. Now you're getting there.
Do I have some slides?
Yes, sir. You're good to
All
go.
right. Well, you know what? It's kind of funny. Teams has decided for y'all's benefit not to let my camera work, so you don't get to see me anymore, and so that probably helps you all. But you can at least see my slides. So let's jump in. You know what? With getting to do this with Mark and John and these kinds of times, I get to be kind of the bearer of good news and get to talk about cattle prices. And we continue to have prices really at just amazingly high levels. And we got a lot of good reasons for those prices to stay historically high in coming months. I'm left with some questions, and this will kind of guide where I'm going to go here. I kind of think, my gosh, are there any stockers left to buy? Certainly, I think we saw a lot of early selling. If we look at some of the auction market numbers moving, which should leave us with a little bit of concern I think a little bit of concern about as we go into really wheat pasture, stocker season, winter stockers. These things are going to continue to be very expensive, which puts a lot more risk in this. Even though we tend to expect seasonally fall calf prices to fall in the fall a little bit seasonally, boy, tight supplies I think leaves us with really high prices. I'm interested in beef prices too, in terms of the retail market, about, how much can beef prices decline seasonally? We often see prices decline a little bit in the fall as we get past grilling season. We get to more fall consumption patterns, yet with so much tighter supplies, I think it makes it very difficult to see that happen. Trades, I think, an important picture. Certainly our exports are falling fast. Back to demand, can demand really will folks continue to buy, particularly with beef becoming relatively more expensive than the alternatives? And then with cattle on feed and Mexican cattle, I think we might be looking at this next cattle on feed report. Will Texas stay remain the largest cattle feeding state? I think with this decline in the border closure and no cattle coming from there, that's probably at risk. It could even switch to being number 2 here in this report that will come out Friday. But I think there's some interesting questions in the market. I'm going to throw you out some charts. Certainly look at 400 to 500 pound calves, number 1 steer calves, Southern Plains. This run really since mid-year to averaging over $5 a pound. We've really seen an amazing counter-seasonal run. So my comment about having any stockers left is really related to this. This run in prices has really been, a little early for a lot of buying for wheat pasture, yet combined with, at least some rainfall in wheat pasture production areas might, further north of us, certainly would suggest it's just amazingly tight supplies just when we might actually have rainfall to establish some grazing. And I think that puts a lot of more risk on the stocker side of things, but certainly higher prices. We would normally expect prices to decline a little bit seasonally. I think there's still time for that. If we look historically, we're a little bit early for some of that decline yet, with just tighter supplies overall and good demand for those calves. I think that seasonal decline, it'll be a little tougher to see that happen. Although, you think as prices go up higher and higher and higher, there is more opportunity for them to come down a little bit. But it doesn't change this fundamental idea of, gosh, prices are high. They're going to stay record high, and they're going to be higher than last year and certainly higher than a 5-year average. Now, on the cold cow side, it's a little, I think we certainly see a seasonal pattern where prices decline into the fall, where most of our cow culling occurs. And you look at this, we've probably kind of topped out on the cull cow market in the last few weeks and last couple of months. Really, we get out of grilling season, even though we have just amazingly tight supplies of lean beef, and we continue to set new records in, say, the 50% lean beef trimmings markets to go into ground beef. we're really, we probably sort of topped out on the cull cow market a little bit, and I expect a little bit of seasonal decline, but certainly nothing. I don't think there's any indication of anything drastic happening there. We got tighter supplies and ground beef needs, and so that's a recipe for keeping prices at record highs. I think key in this discussion, we talk a lot about demand, and we continue to have good demand for beef. People are buying. I think the supply component of this is pretty important. If we look at weekly beef production, and this solid blue line on my chart is this year. The dotted line is last year. The red is a 5-year average. Through the first quarter of the year, we actually had beef production even with a year ago. And we get to April and beef production really starts to decline. We see some large deviations from last year, including some double-digit declines in the summer. And by double-digit, I mean 10% year-over-year declines in beef production. A week compared to the same week a year ago. Even after Labor Day, we've got a week's worth of data after Labor Day, and we continue to see that same pattern holding up, where normally beef production tends to see some seasonal increase into the fall. I think if we look at cattle on feed numbers, at marketings from feedlots, beef production, partly from the beef side of cull cows, it becomes a little tougher to see this growth. Now, one of the things I'll be looking for is over the next few weeks, do we see some increasing beef production compared to, say, July and August? That's what we would expect to see. Beef production is going to stay below a year ago. It keeps that tight supply part. But can we see a little bit of seasonal increase compared to kind of midsummer, July, August? And that gives some relief, at least on the wholesale market or consumer side, for maybe a little bit of decline in price, but still prices that we consider at record high. So it's a bit of a nuanced argument in that, seasonally, we need to think about comparing to a year ago, but also comparing to the last few months where we might get a little rise in production. But with fewer cattle on feed and fewer cows, particularly on the beef side of cull cow market, it's going to be tough to see a lot of increase, I think. Jump to trade for just a second. I wanted to highlight our feeder cattle imports from Mexico. They continue to be at zero with the border closure due to fears of screwworms. What I want to highlight, though, is if we look at this red line, a 5-year average, what do we normally expect the seasonal pattern to be in imports? We're getting to the point of the year where those imports historically rise to the highest point of the year. So if we think about effects of this border closure on calf prices or feeder cattle prices, we're ratcheting back supplies even more because those cattle aren't coming. If we look at cattle on feed placements, this is going to continue to affect placements, particularly in Texas and the Southwest. We'll see double-digit percentage declines in cattle placements, I think particularly in Texas because we don't have those cattle coming. The same holds for the rest of the Southwest as well, and Southern Plains where we would normally feed some Mexican feeder cattle. They aren't coming and the gap's growing, which really suggests more pressure on prices, upward pressure on prices from tighter and tighter supplies. Yet that's going to continue to affect consumers and beef production in that those cattle are not showing up. They're not going into U.S. feedlots. They're not coming through our packing plants, and it's tighter and tighter beef supplies. That's part of this run to record prices on the beef side is just simply this lack of supply, and this is part of the story. And so I think it's important to recognize this seasonal change going on. Exports, I think it's important to take a look at exports. Exports are declining dramatically, and which is exactly what should happen given record high prices here. We're importing more beef, we're exporting less. That is simply a market response to high prices, and this works to pull back on prices. We keep more of this beef here because it's not going somewhere else because we're just less competitive in world markets. And but as you look at this, yeah, we're exporting less than we have on average. We're exporting less than last year, but we're still exporting more than 200 million pounds a month in our latest data from July. So, but it is recognizing this change, I think, is important. And if we put that together with a net beef imports minus exports, we're boosting beef supplies in our market by importing more, particularly lean beef trimmings to go into ground beef, and we're exporting less. And so the net is we're adding a little more beef on our market, reining in prices a little bit simply through the market working through trade. Of course, trade continues to be a contentious issue between tariffs, particularly on Brazil, going on. So, but that gives you, I think, a glimpse of what's happening on the trade side of things very briefly. We've got a cattle on feed report that will come out at the end of this week. Today is the 17th, if I remember right. We'll get a cattle on feed report. My expectation is we're going to have about 2% or a little more than 2% fewer cattle on. Yeah, 2% fewer cattle on feed. I expect placements in feedlots to be down more than 10% in August. Marketings were down about 13%, I expect. So again, tighter supplies, fewer placements. Certainly Mexico's part of that, but also just plain fewer calves. If we are right on the cusp or on the edge of starting to see some expansion, holding back heifers, I think that really contracts the number of cattle on feed in coming months because those heifers aren't going to feedlots, they're staying home. And that's something I think we'll be looking for as we get into the fall and weaning and things, broadly speaking, across the country. Then, I think we'll see some even larger declines in placements going on. But I think that gives you sort of a notion of cattle on feed numbers as well, which plays into production next year. I will end with a little bit on kind of retail prices, but I thought I'd start with the wholesale box beef cutout value. That thing has surged again to record highs in recent weeks and beginning to come down. This kind of up and down within the year pattern is something we normally exhibit, although these are certainly at high prices. Again, much tighter supplies. If you go back to that beef production chart I pointed out, some large decreases in production has really boosted these prices in the face of folks that continue to want to buy the product. So this up and down nature as we get buying patterns, production patterns, we're going to keep wholesale beef prices high. And so I think there's not much to change this overall picture, I think, at this point of beef prices. But notice, I want to point out one other thing. This rising cutout wholesale market rises again to over $4 per pound, over $400 per hundredweight. The wholesale and retail markets are related, and this rising prices in the retail market should relate us to retail beef prices as they are reflected in the Consumer Price Index report, which is what this chart is retail beef price for choice beef. We are across a variety of cuts. We are almost to $10 a pound. We hit $9.85 for choice beef in the latest CPI report from earlier this week. And if we relate this back again, this is backward looking by a month. Well, you take a look at the wholesale market with it surging higher, and we're left with this that the retail prices are going to go higher too. One of the things I'll be looking for is through the end of the year is, do we see this kind of seasonal kind of sliding back of prices? I think it's going to be difficult to do that with tighter supplies. And the supply side is keeping that pressure on. We ought to see a little bit of decline, but it's not going to move us away from these high prices that have everyone concerned in the marketplace. It's just simply because unless you have big changes in what people want to buy, we keep prices high with these tight supplies. Now, I will point out, retail prices matter in terms of consumer demand. it's beef prices compared to my other choices. And so if we look at beef prices increasing, my kind of royal blue line here at the top, the red line is pork, the black dotted line is a kind of a composite broiler price. We have surging beef prices increasing relative to folks' other choices. I think that's where the concern on demand is, that relative prices matter. We have not seen a lot of evidence of a whole lot of switching going on, but in beef and meat markets, we consume what we produce, and we're going to also throw in there imports and take out exports. So those are our available supplies. So as our supplies contract, we're going to eat less beef. We eat less beef because we produce less beef. So that might tell you right away somebody's not buying as much beef. But we don't have a lot of evidence yet of really large switching away from beef to these other cuts, even though relative prices are getting further and further out of whack. But I think that's an area of concern in terms of demand going forward. And I'll tell you what, that's my last slide. Boy, I think these are exciting times certainly in cattle markets and beef markets, just amazing prices. And I should say one other thing too, as Mark talks, one of the things that's boosting prices for calves and feeders is certainly the feed market. And by that, I mean corn. There's no question that's providing the bump to push these prices higher, just simply with lower cost of gain, lower feed prices. That's part of this overall cattle market picture as well.
Dr. Anderson, I got a chat question right quick. Do the markets and trends suggest a transition to a focus on rebuilding the cow herd and possibly retaining heifers?
I think prices certainly are telling us that. But, we're still stuck in a tug of war between these tremendous prices and do I want the check now versus her future productivity. But I think that's really starting to weigh towards expansion. I saw yesterday an article in Drovers Magazine, a little survey of producers, and 46% of ranchers that responded to the survey intended to increase the size of their herds starting this year. And so that 46%, that's a pretty big number. But, as we look at some of the rest of it with, heifers going for sale in terms of feedlot placements, boy, we don't see a whole lot of evidence yet in terms of expansion. So again, I think we're right on the edge, but boy, the market signal is to probably to expand. But if you're going to get $4.80 a pound for that heifer calf, or $4.60 or something like that, that's a pretty strong signal to sell and put that money in your pocket. So I mean, it's really, we're just right on the edge of this happening.
Sure. Okay, great information. Again, thank you for getting up and being with us this morning. We'll move on and possibly got a question for Dr. Anderson if you're going to be on at the end, but
I'll be on.
Okay, well, we'll move into Dr. Mark Welch, our grain marketing specialist, and let him give us an update on what's going on with the grains. Dr. Welch, take it away.
All right, Bobby, great to be with y'all this morning. Let's see, David, I'm still seeing your screen. There we go. Let me see if I can find how to share mine again. Like I say, you think we'd just a little more seamlessly down, and let's do a slideshow from the beginning. And hope that's got us up and going.
You're good.
All
right. Take it away.
Well, again, thanks for the opportunity. I'm going to touch on several aspects that you've already heard this morning, some of the supply and demand fundamental stuff that we're seeing in the cotton market, apply that to the grains, as well as perhaps some implications on what the livestock sector has for our grain use, and as David mentioned, with low prices, is that stimulating some use for grain, but some other restrictions as well. And I'm really glad to see Wayne Cleveland on the call, because I think I'm going to talk kind of big picture corn market stuff. And sorghum and corn obviously move along together, but with the detail that he can provide on some particular aspects of the sorghum market, I think will be very insightful this morning. And I'll always appreciate Wayne being on here. So just moving ahead to kind of what's going on in the corn crop here in the U.S. We're projecting a record yield this year. We've had crop condition ratings all summer long of about 70% of this crop in these green categories. That's the excellent and good ratings. The yellow would be the rated fair. And then you got your very poor and poor down here at the bottom, running below, even though it's come up a little bit the last few weeks, still down below 10%. Just outstanding ratings month to month as we've gone through the summer. Now, you can create an index, from these percentages, and that gives you the ability to compare, this week's ratings to last week or to last year or to an average. And the black line in this case would indicate this year's crop condition index compared to the long-term average. And with these kind of ratings, have been well above average again throughout the summer. I've fallen off a little bit as we've gotten here now toward harvest nationally, but still just outstanding crop ratings. Now we're going to zoom in on that crop index piece of this just a little bit in the next slide. And now you can compare, this is the crop condition index rating for the 25 crop compared to 24 is the blue line, 23 is the green line, and then the black dotted line in this case would be the long-term average of an index. So that would basically tell you if we're along this black line, that ought to be an average crop. Well, an average crop in today's world is about 183 bushels per acre. It's an outstanding yield number. We set a record in 2023 at 177, a new record in 24 at 179, and USDA's updated estimate now for the 25 crop, 186.7 bushels per acre. We are falling off a little here at the end of the year. Typically, that's what we do, but then we stabilize about this time of year. So it'll be interesting to see if we continue to drop off the next week or so, or if we do kind of stabilize these ratings, and that may give us some indication of whether an additional trim in this yield estimate is still in the cards, or we're going to level off maybe around this 186. Looks a little more doable given these kind of ratings. So we're even though we're so late in the year, harvest is really starting to pick up across the country. It's not done yet, and so we still trying to get a handle on that. That yield number is still, I think, the primary market driver in the corn market today. That puts this year's yield in perspective. Again, that blue dotted line would just be trend line growth going back to 1980. And we normally add just under 2 bushels per acre per year, what an average crop looks like. And again, the projection for this year would be about 183 if we were average, and kind of in relationship to that, what that 186.7 looks like. So just an outstanding kind of production number. So changes in the WASDE. If you look at from August report into September, first of all, the big market mover, I think, was what happened on the yield, dropping that yield from 188.8 to 186.7. But we also found another million acres. So by the time you combine the drop in yield with an increase in acreage, production estimates actually went up with that lower yield number. And combined with that, USDA then lowered our expectations for fuel, corn for fuel in the old crop year. So we added another 20 million bushels of supply to this year's crop that we're not going to use from last year. All said and done, we added about 93 million bushels, given that yield cut. That was, again, much of the focus of the news and commentary coming out of that report. Domestic use did not increase. We did increase exports, however, the projection for the new marketing year of 100 million bushels. So you can kind of see that balancing act going on. We increased supply 93 million, increased exports 100, and that gave us a small drop then in our ending stocks of that 7 million bushel change from the August estimate into September. Tightened over our carry-up just a little bit, still around that 48-day carryover if you look at days of use on hand at the end of the marketing year. And then USDA left the expected season average farm price for the 25 crop at $3.90 per bushel. Compare now the updated 25 crop to the old 24 crop numbers. This is where you get your price pressure. We're increasing supply year over year of about 9%, increasing total use by about 5%, but that's still a recipe for lower prices. And moving from a 430 season average farm price to 390 is that about 9% decline in price, which again is what you'd expect the fundamental relationship or that to be. And just to put that in perspective, again, with days of use on hand at the end of the marketing year, if that pile of grain gets bigger and bigger, our supply cushion grows. That puts downward pressure on prices. This is the national season average farm price for corn. The latest estimate for 2024 is out here at about a 32-day carryover, 31. And then we're expected to increase that out to about a 40-day, 8-day carryover here for the 2025 corn crop. And prices, again, right around that 390. So fundamentally, yeah, if this is where we stay and this is kind of where we end up for the year, it kind of makes sense where we've been given past years between kind of fundamental supply and demand relationships. In addition to that, we've got a big corn crop in the rest of the world. Not only do we have record production in the U.S., that's indicated by the red portion of this chart, but then the blue portion would be all the corn that's produced outside the United States. And so we've got a record U.S. crop, record foreign production, creating a tremendous amount of corn supply across the world. But I think it's important to put in context some of the use components when it comes to corn. Excuse me. This is from an article produced by the folks at the University of Illinois in their Farm Doc publication a couple of weeks ago. And one interesting component of this chart, this is showing the consumption of grain and oil seeds and the production of grain and oil seeds. And you can see that since 1981 in this chart, domestic consumption has exceeded production and is getting wider and wider. And the focus of these numbers are for all grains and oil seeds outside of the United States, China, and South America. So you've got these top ag producer superpowers. Well, what's going on in the rest of the world? And what we find is that since 1981, that level of consumption has outpaced production every single year, and the average of that is getting wider and wider. The average in the 1981 to 85 was 107 million metric tons. In the last 4 years, it's up to 141 million metric tons. And what this highlights to me is that we are seeing a world in which the export of grains from these primary production areas, of course, China doesn't export a lot, but with South America and the United States, the opportunity for the global marketplace needs our product. That's where the growth, where the demand is continues to churn as we see that the consumption levels continue to grow, but they can't grow enough of their own. They are going to be more reliant, increasingly reliant on imports of grain and production from that comes from China, South America, and the United States. And so another way of looking at that same picture is the world days of use on hand at the end of the marketing year. We're expecting an increase in the U.S. this year with this record corn crop. However, the global carryover relative to use has been dropping for 10 years. In fact, we're still looking at the tightest world carryover stocks to use since 2012. And so that global situation is still relatively tight, very vulnerable to a production disruption in these major producing areas. As long as the big three continue to make a crop, big crops in the US, big crop in China, big crop in Brazil, yeah, we're probably going to be okay. But given the dependence of the rest of the world on what we produce, given that relatively tight global supply and demand situation, if we were to see any kind of hiccup on the production side, we are poised for significant volatility in these grain markets. Keep setting record crops, we're probably going to keep coasting along. But again, the undertone of that is it wouldn't take much of a disruption on that production side to really cause some significant impacts in our market prices. We've been following a seasonal pattern this year, pretty close to normal. This is the December futures contract. The red dotted line is that seasonal pattern. Dr. Robinson kind of laid that out for cotton, and they kind of look a lot the same. Typically peak along in June and fall off toward harvest. Those kind of match up pretty well. If we were to shift that seasonal pattern, shift that thing to the right about a month. And instead of dropping it, setting the low in early August, let's set that low in early October. So move it over a couple of months, and we've kind of followed along. And so I think that's why our final production numbers are so important. Do we kind of stabilize along here, kind of what seasonally we do? Because normally then, okay, yeah, we did make the crop, we fall off a little bit. If that yield continues to get trimmed, we might yet see a little more price strength as we head into the contract expiration of that December 25 contract. But now that's kind of laying the groundwork for where we headed for 2026 crop. The projections have just come out from the FAPRI organization of the University of Missouri, the Food and Agricultural Policy Research Institute. They do long-term projections for a lot of ag policy analysis. And their first run at the 26 crop would see us pulling back in corn acres by about 6 million, harvest about 5 million fewer. Those are all going to soybeans. Yield, again, we talked about what trend line yields look like in today's world, that'd be 183 bushels per acre. They're looking at them with fewer acres, lower yield, maybe 1 billion bushel fewer produced, and then drops that total supply, of course, bigger carryover, given this big crop year we're coming off of. But total supply down about 500 million bushels, about 3% drop in supply. Concerning to me is now we move into the demand categories with them not seeing growth on the domestic use categories, not seeing growth in the export markets, and now we're starting to pull our total use down compared to the year prior. So again, not seeing that robust kind of consumption kind of numbers. Even though we are looking at a somewhat smaller crop. If these numbers play out and you drop that carryover from a 48-day carryover down to about 43, that does create the opportunity maybe for a little better price. And again, their projection would be consistent with that. And they are projecting a season average farm price for next year's corn crop, the 2026 corn crop, at $4.20 per bushel. To put that again back on our chart comparing prices and carryover, that kind of keeps us moving right along the line, but closer to the 40-day carryover, which just as a reminder, we drop that below 40, that's the opportunity for some really volatile, very high prices. And at this point, they've moved us a little back to the left, but still on the right side of 40, which gives us that price around $4.20 with that 42, 43-day carryover. And to put all of that in context, where does that leave us for our farm economic situation? Again, this is information from the University of Illinois using Central Illinois corn and soybean farmers. What kind of financial situation are they in? Well, this is projected to be the third year in a row of net losses for those producers. 26 is projected to be another year of losses. And then the only thing easing some of that pain are the government payments that came in the form of those ECAP payments for the 24 crop, with the increased reference prices and calculations for the ARC program and for PLC, significant program benefits being available from those particular programs, but not making us whole. So again, it just highlights, I think, the degree to which even with the support that we're getting on the government side with this relatively low price environment that we're in, it creates some very difficult financial situations that we can relate that across our Texas crop as well. This is just a kind of, again, zeroing in on a central part of the Corn Belt. So if we're looking out for next year, I think one of the demand pieces that would really give us a boost to that price outlook is from the trade side. Again, the demand is out there. The world is calling for our production. And can we produce policies and programs that let us continue to have a vibrant and relevant presence in that global marketplace? I think we could see prices moderately higher than in 26 compared to 25. But again, weather will be the key determinant of that. But again, fundamentally, we could be moving in a little better situation just with the acreage shift But again, on the use side, that global marketplace is going to be so important to that. And then I'm going to close with highlighting a couple of programs that we have coming online here in just a couple of weeks, talking about the concern around building a farm safety net for 2026. That's going to be our focus for our Master Marketer program, developing a marketing plan. These are 2-day marketing plan workshops. We're going to be at the Wharton Civic Center October 22nd and 23rd. We're going to be at the Weslaco Research and Extension Center. This is going to be November 12th and the 13th. And we're going to talk about crop and livestock insurance, farm policy, finance and taxes, budgets and break-evens. We're going to have weather and climate risk, production, marketing, risk management strategies, try and develop a safety net in the program for that 2026 crop year of how we put together a plan, what is within our control to perhaps manage some of that risk and what looks like a very difficult financial situation on the crop side right now. How do we put a program together that protects our operations to the greatest degree we can, what we know today for 2026. And for our livestock producers, I think they might be interested in particularly not only the production strategies in terms of range and forage management, but also finance and taxes. Some folks are making money, and so might be some insight around analyzing just how we are evaluating our financial situation, and then how we might manage what have now been maybe some more prosperous times for some of our producers in terms of a finance and tax situation. So really excited to bring that program to the coastal bend area, and then on down to our folks down in South Texas. So I will stop right there. Bobby, again, appreciate the opportunity to be with y'all today, and be hanging around if there's any comments or questions.
Yeah, greatly appreciate it. Really good information. Thank you for sharing all that with us today, and just appreciate you being on. So we'll move right on into Wayne Cleveland. He's on with us this morning. He's with the Texas Sorghum Producers Board, and greatly always great to have him on with us. We get a good perspective of what's going on in the grain sorghum industry. So I'll turn it over to Wayne.
Good morning. I'm sitting outside another meeting, so fixing to go in at 8. So I'll try to keep these pretty brief. Can you guys see my screen okay? Am I sharing all right?
I see it, Wayne.
Okay.
Yeah.
All right. There it is.
It's a little fuzzy on my side.
Okay. We may have to just roll with fuzzy. I'm operating off my cellular, and I'm in Abilene, Texas, so things here get a little wonky. So appreciate having us on. A lot of different things going on. I'll just kind of go through the important things here, and then a couple of charts. Always appreciate Mark's comments, particularly days on hand. I was visiting with my neighbor, Stephen Lostovica, who trades a lot of cattle, he and his family, and he was telling me they had a potload of cattle that was worth $200,000. And I told him I had a hopper bottom full of grain sorghum that was worth 1 cow. And I think that's a world we live in today. That discrepancy is really unreal. Good if you have cattle, not so good if you have grain. That's my great grandfather there on the right. He's on the Chisholm Trail riding the circuit, trying to save enough money to buy land, to buy a little piece of land. He bought the piece of land. He lost it 3 years later, and my other great granddad bought it. So we've always had a lot of tension in the family, but we still have that piece of land today. Important for growers, if you're going to talk to growers, is reconciliation package. You heard Dr. Walsh talk, Mark talk about the programs that are going on. National Cotton Council has programs going on. Southwest Council has programs going on. Talk about the Farm Bill. Wasn't really a farm bill, is more of a reconciliation bill. I'll talk about that in just a little bit. The big thing for growers is reference price on PLC, and you guys know PLC and ARC will be selected at Farm Service Agency this year based on which one's better. The reference price for sorghum was set at 440. We're on what's called an escalator, which puts that price closer to 470 based on the previous year's average. I think our average national price is going to be 370 to 380. So you can do the math from there. You're looking at around $1 a bushel payment in PLC. The bad news is that's because low prices right now. And the really bad news is won't get it until this time next year. But nevertheless, take a look at that price. Big win for sorghum in the reconciliation. We were able to get 45Z, which has got 3 ethanol plants on the high plains, bidding positive basis a couple of weeks ago. Our orphan program from the Farm Bill called 9005, which allows us to put advanced biofuel feedstocks into those ethanol plants. We were able to get that through reconciliation, which was an absolute miracle. Our MAP, Market Access Program, Foreign Market Development, which all commodities enjoy around $208 million. That's moving up to about $400 million, which is a big win. I think the administration realizes we have a lot of work to do internationally promoting our commodities. As Mark kind of pointed out there, there's a demand for these things. Just everybody's terrified of the tariff markets now. And if I had to make one comment, it's everybody's terrified of the tariffs, and if they'll get a tariff once that product gets on the water. That happened to sorghum in 2018 when we had 20 boatloads of sorghum headed for Spain that got hit with 180% tariff from China as a showstopper. We'll see Farm Bill Light start talking about that, where they'll try to move this MAP and FMD fund over. This is probably about 2% of the money in Farm Bill, but nonetheless, it needs to get done. So we have a Farm Bill. That's going to be a big fight because the Republicans got what they want on SNAP reform by kind of pushing that through without asking a lot of questions. Dairies, you're seeing them grow exponentially. We have a program on the high plains where we're working with Shared Group on a kernel processor. Problem with sorghum silage is when you process it through a silage chopper, you get about 10% of the berries processed. With this new processor, you're looking at a 95% processing of those berries. It's an absolute game changer if it works. We're working with them. We've invested $300,000 in the Tech Dairy program. Again, there's about 600,000 head of dairy cattle on the high plains. Visiting with Darren Turley, he indicates that that's probably kind of at a stalemate because of the amount of money it takes to put in a dairy. Trade deals and TRQs, thank God we started this thing in February and not last month. I think we're getting a little closer. It's hard to believe that TikTok would hold up all the trade deals and cause all this angst for growers. But as I read that, and I think a lot of other people do, TikTok is a big part of ag trade right now. We have our export sorghum in September in San Antonio. We have about 80 of our international customers coming in. This is something that the Sorghum Checkoff puts on. We have about 80 people that sell grain coming in. Timing couldn't have been better. This morning we learned that Pakistan actually bought 5 boatloads of sorghum. Those will be going out of the port of Houston. There's a lot of sorghum in the world right now, Mark. We think there's about 150 million bushels of old crop that's lingering in Kansas as they start putting new crop on top of it. So sorghum's probably at a historic low price. We saw Italy buy a boatload of sorghum last week, as well. I was visiting with Manny Sanchez. He's in Mongolia, of all places right now, and it looks like they might buy a little sorghum. So we're taking Vietnam. We're taking a little group over there pretty soon to China as well. Remember, China has a 0% TRQ on sorghum. So after all of these bilateral tariffs get taken away, we still have a 0% TRQ on sorghum, which means they can import as much as they want at a 0% tariff rate quota. Don't let these other bilateral tariffs confuse you with that. The WTO still has its rules. They're still in place, and all the dirt will settle. Baju, that's our specialty market, and we tell everybody if China goes away, we're in trouble, and we're in trouble. We got a lot of grain, and it's trading around $3.40 on the coast right now. State legislative, worth looking at TAFA, Senate Bill 43, which expands Texas Ag Finance Authority and makes it a little easier for growers, increases it from a couple of million to 100 million. We worked awful hard on that. Maha bill in state tried to list atrazine and glyphosate as a food additive. Again, our shop worked really hard on that. We were able to get those 2 chemicals removed from the 52. And then again, we're working on what used to be called our green grant. We call it the Advanced Markets for Producers grant on High Plains. Allows us to go in and get lots of detailed information on grain sorghum as far as what's happening in the dirt. I do have a couple of little slides here real quick. Sorghum silage, you can see total farms decreased by 11%. Acres increased 27%. So people going out of business, other people buying them. Total production of silage increased 16%. Total farms, silage farms increased by 42%, which are dairies. Total acres increased by 129%, which I think probably came from cotton, a little bit of corn, and total production of silage is up 80%, which is really unbelievable. We think there's around 650,000 acres. Again, that's all dairy. Here's our top consumers: China at 17%, Nigeria, Mexico. We still produce 15% of the grain sorghum in the world. Nigeria is next. They use a lot of that for beer. They drink a lot of beer in Nigeria. The rest of them, they eat it. Mexico used to be our biggest consumers, pretty low on the list. Ethanol production, we continue to dominate there. And again, meat consumption, go back to David and Mark's comments. China's 30% of meat consumption in the world. I mean, that's huge, and that will continue to grow as they develop a working class. You'll see the same thing in India, visiting with Reese Kennedy, our consultant there. He says as that middle class continues to grow, they'll eat meat. And it won't be pork and it won't be beef, but they'll continue to increase the amount of poultry they eat. So big market there. I think that's about my comments. It's this guy in the middle. He's the largest buyer of grain sorghum in the world. We'll be with his son next week. We'll be with him in October. We continue to pedal as hard as we can. Grain sorghum, having groups over. We look forward to having these boats again on the water. Again, all things pinned on China. That's it for me.
Oh, great. A lot of really good information. Little positive in there as well, but hopefully things kind of changed a little bit. But greatly appreciate you being on. We'll let you get to your next meeting, and thanks again for helping us out. Really appreciate you being on. I guess with that, only thing, I got a question for Dr. Anderson right quick. Have you heard any rumblings about, as the weather cools, the Mexico border opening, when we get where screwworms probably not a problem as we cool off?
I haven't heard anything about that.
Okay. I was just curious.
Yeah, you would think, back in history, fly season was April to October. So you get into cooler winter months and saw a decrease in activity. I think the whether the border is open or not still remains a big old tug of war between even parts of the industry lobbying for different things. So I haven't heard any rumblings of that happen. I'm sure folks are still working on trying to open it, but I haven't heard anything on it yet.
All right. I just didn't know whether you might have. So anyway,
good question.
Again, thank y'all again for being on. Thank our sponsors. Carrie, you got anything you would like to add if you're able?
Bobby, thanks again for all you've done to facilitate the conversation. Great reports and information from those of you that are absolutely the leading experts in bringing that information to our constituents and clientele. I'm excited to get the link posted, see how many views we can pick up from sharing the information, because I definitely think it's relevant and timely.
Thank you, Karen. Dr. Welch, Dr. Robinson, if y'all get a flyer out for that, go ahead and send that to Karen and I, and we'll try to put it in our newsletters as we go forward.
We will. It's hot off the press, so we are ready to get that thing out in the country. So we're going to be getting a copy of that later on here this morning. We'll get it to you.
All right, great. Thank y'all again, and appreciate your time. Y'all have a good day.
You too. Thanks.
Thank you.